Hello and welcome to another brand new episode of ET Now Insight, where we break down different aspects of market and help you decode trends. This is Mansi Dave and today's focus is on the Indian IT companies. It's been a mixed quarter one for Indian IT majors. Revenue growth remained elusive and discretionary tech spending continues to slow across key geographies. While engineering, research and development remains a bright spot, segments like manufacturing and retail are clearly under pressure. But the street is still holding out hope. FY26 is now being pinned on a broader global recovery, and any signs of turnaround will likely depend on a pickup in demand and deal momentum. So the big question is, can Indian IT stage a comeback? Expectations are high, but we need to answer that question. Infosys' surprise beat may just offer a glimmer to optimism, but is it enough to shift the narrative? That's another question, an important one to ask. Before we decode all of this, let me go across to my colleague Abhishek Gaushinde and understand a roundup of the quarter one earnings for the IT majors. Abhishek, with Infosys numbers, the major IT earnings have been concluded. What's the roundup of the IT earnings? And of course, we also have to keep an eye on the mid-cap ITs, but we start with the larger players first.
So on a broader note, what we can say that since the beginning of the quarter result season, the expectations were quite modest and there was no major surprises in the numbers, if we can say. Although Infosys has shown some statistical beat, but that is not the trend that we can build up for the coming quarters. The thing is that in this quarter, the street was expecting that some kind of positive commentary come out related with this tariff war. Second is on that some kind of a commentary related about the especially the expenditure that their clients are looking for in the coming quarter. But on all these two fronts, it was a kind of disappointment. There is a clear-cut thing is that this tariff war has put up some kind of a pressure on the client side, and that has been reflected in their numbers. Most of the management has given a somehow positive commentary for the BFSI segment, but there was a clear-cut caution regarding the manufacturing side, especially on the automobile side. Third is that the deal wins were quite what we can say more of a realistic things. It's not something that which we are expecting, on which we can build up earning upgradation cycle from here. And the most important thing that one should have to note here is that this headcount addition. So there was no surprisingly kind of a headcount addition that we have seen this quarter, which is saying that these players have these IT players themselves have been taking a caution on this headcount addition, which is saying that they don't have a kind of confirmation or a confidence on the project execution in the coming quarters, although they have a strong order book pipeline. Fifth thing is here is that if you can see that on a broader note, except TCS, which has given I think -1 to 1.1% kind of revenue guidance for the coming quarter, most of the players have maintained their upper band of their guidance for FY26. And our understanding is that if this tariff related fear would not come down in the quarter two, then we may see another round of this earning cut down in the coming quarter also.
Slow, rather weak start to the IT earnings, and it also dented the sentiments for the entire earnings season because expectations were high, and we did start the quarterly earnings season with the IT numbers, the IT majors, and then one by one. While we did see the IT earnings coming and the weak sets coming in, it was an absolute no-show or a weak show, one can say, for the IT sector. Not to forget, it is a sector which is connected with the global impact as well. Now, what's happening in the US with the technology-heavy index NASDAQ should have an eventual impact on the IT, domestic IT majors as well, domestic IT mid-cap players as well. But that's not the case. We see NASDAQ performing in trades during sessions, but the domestic IT companies are still not being able to see the performance as it should. Let's also listen into what the managements had to say post their quarter one earnings.
People are in a wait and watch mode, and I have a feeling maybe once these discussions are over, maybe by sometime in July and August, there will be greater clarity on the direction the trade discussions take. And also the new bill will be in place, that will also provide more clarity. I think maybe first week of August onwards, we should see more definitive direction in the market.
We've increased the lower end of our guidance as we go closer into the, progress into the year, closer towards the end of the year. We typically narrow our guidance, and that's the first part of what we've done, which is increase the lower end. We still see things within our guidance where we look at some things which will give us good traction. For example, what we've seen in the consolidations. We've seen very strong work that we've done on AI with agents, and we see that. And we also see the economy globally, both in Europe, US, going through changes. So keeping that in mind, we've narrowed the guidance and increased the lower end.
The focus as an organization is to make sure we execute these deals. Some of these deals will take time. Similarly, some of the mega deals that we have, we are working through the process. And that's the reason why I said the second half looks much better than where we are in first half, because these deals will start getting executed by the team.
We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Our largest clients are growing much faster than the company average, and so we remain confident about our focus on our largest clients and our opportunities to grow them.
No, the only point I'll say is quarterly, the macro is so uncertain that there's quarterly variation on different customers at different point of time. So I think we should look at it as more as annual trends, and this is a metric that we had committed to share in our annual report out, right, on our long-term plans.
As you did see, these were the tech majors on their Q1 earnings. They had a word with ET Now, TCS, Infosys, Wipro, HCL Technologies and Tech Mahindra, and all the managements talking about their growth plans moving ahead and also what went on during the Q1 after the earnings scenario. But taking a deeper look in the mid-cap IT plays also, Abhishek, there was a time when we used to literally compare whether to go with the larger IT plays or to move to the mid-cap IT. And of course, mid-cap IT looks interesting. We're looking interesting. But if we see the picture now, persistent, Coforge, even after the numbers, we do see a real downsurge. 4 to 5% of downtrends in just one trading session, and this downtrend continues from session to session.
First of all, I correct myself that Wipro has indicated for -1 to 1% kind of a growth for Q2. The thing is that in the mid-cap space, what's really happened here is that they have been showing a strong growth guidance, and obviously at the kind of a size they are likely to deliver a higher growth than that of the large cap players, and that's why the whole street has built up a portfolio where they have given a higher weightage to this mid cap players. But what has been surprisingly happened in this quarter is that the players like Persistent and Coforge and other players who are considered to be mid cap players have not shown the kind of outperformance in their Q1 earnings. And when the valuations are pretty high and your performance is not upbeating, then obviously some kind of a correction always happens. Even though this Persistent has maintained its FY27 guidance of, I think, $2 billion kind of a revenue, but somehow at the valuation at which it is, it requires some kind of to deliver some kind of outperformance in its earnings, which was not visible. So one can say that in the case of a Persistent, it's a natural kind of a correction, especially happening on the valuation side. Second, the case of the Coforge, which has seen a strong, what I can say, correction in today's session. So in the case of a Coforge, that street is building up a concern related with this cash flow kind of a thing, that what kind of a cash flow it would have in the coming quarter. There is a thing that it will again go for some kind of a capex or a inorganic growth kind of a thing. So in that case, the correction is happening. But what my read on this Coforge and Persistent is that the kind of a valuation at which they were trading, it requires some kind of a caution considering the kind of a growth which they have been delivering and which they were expected to deliver, and increase in the valuation gap between the mid cap and the large cap players. So because of that, we have seen a kind of a correction in the mid cap players also, which is, I think, quite justified on a fundamental basis.
Abhishek, I completely second the thought. Be it the larger IT players or the mid cap IT players, none of them are trying to help support and boost up sentiments of the markets at present. But then while we decode the numbers, be it any sector, not just the IT sector, there are a lot of parameters which one has to analyze. And in particular, if we talk about the IT sector, yes, we have a lot of parameters here as well, be it the attrition, the AI, the developmental trend, the updates which keep on happening in the information technology space. Are there any key trends emerging according to you, and what is the outlook of maybe any particular stock which you think will kind of in the IT space, be the larger one or the mid cap, help support the market, if not immediately, but in shorter time frame?
See, it's right that one trend is clear that we don't see any kind of earning upgradation in FY26. The thing is that if things would not improve in Q2, especially on the US tariff deal side, then we may see a further delay in the decision making process, and it may have some kind of impact on this order book cycle in the coming quarters, which would result in their hiring process. And if these things will not turn out the case in which this so far state has been built up, then definitely the headcount would not increase from this current levels, and which is saying that the project execution cycle would not enhance. Second is that if there is no trade deal or trade deal related fear would clear out from Q2, then one thing is that the larger part of this discretionary spending happens in the Q1 or Q2. So the sum of this you would miss for FY26. So one thing is very much clear that even if the things would improve in H2 FY26, we will not see a material earning upgradation in the FY26, and it may have some kind of impact on the initial period of FY27, wherefore the street is building up that things will sort out from FY27. Whatever happen, we will not see this upper end of especially from the this large player side, that the upper end of this guidance will not shift from the current level, although there is a risk that even though this upper end would be matched for FY26. Now on the higher side or the lower side, what we can build up here is that the growth, whenever it will come up, it will be higher in the mid cap space. So again, even though we have seen a kind of a correction in the mid cap IT stocks also, if one has to enter in this IT space, then the mid cap space will give you higher growth opportunities compared to the larger players. But one has to keep in mind that one should have to allow this valuation to correct even in this mid cap space, and then build up or consider them for a portfolio build up kind of a thing.
Absolutely. If at all the market participants have to play out the IT sector and enter the IT sector, it will definitely start with the mid-cap IT plays. So that is one which is more important. But also talking about the Infosys quarterly numbers, it was last among the IT companies that was a part of the Nifty 50 index to report its result, and with that all the IT majors did post its numbers. Now having said so, the management when they gave their commentary and then their rationale behind what happened with the Infosys number, and yes, it was a surprise than the other major ITs, the TCS, the Tech Mahindra, all of them were posting negative results, and Infosys, if not the best, but it was still a good surprise. The management did say that the performance in Q1 did demonstrate strength of the company's enterprise as well as the employee workforce, and apart from that also a lot many things. But then we also have an expert to talk more on the IT sector. We have Sandeep Agarwal, fund manager, Sovolo Investment Managers, to deep dive and help us understand the entire detailing about the IT sector. Good afternoon. Thank you so much for giving your time to ET Now, and it was nice to talk to you. In fact, yesterday when the Infosys numbers were being posted, Sandeep, and yes, Infosys numbers, I was just going through that, and the MD and CEO Salil Parekh did give his views on what just happened and why the numbers were quite a surprise. Of course, a lot of motivational words did come in regarding the employee workforce, which did well. But what do you think really worked out for Infosys? Was it the deal pipeline, the large deal pipeline, which gave a distinctive picture for Infosys while the company did post its numbers?
Yeah, hi, good afternoon, and thanks for having me on the show. So, as you rightly mentioned, the growth numbers and margin numbers were definitely slightly better than what was anticipated, and even the deal pipeline numbers look good. But at the same time, the implied guidance 1 to 3%, while you can see it in two ways, that the bottom lower level of the guidance has been increased by 1%, but the other way to look at is what is the implied growth rate for the next few quarters, which run at very, very low level from minus 0.4% to 1%. So I think, this sector is going through some challenge on a structural basis because Gen AI and Agentic AI, all these things have really, really reduced the effort substantially. And that is reflecting in numbers. See, there could be slightly better than anticipated numbers, but again, if you see the year-over-year growth, it is low single digits. So I'm not very excited, and I believe that the whole sector, the large caps, will struggle for next few quarters more till these things come into base and they are able to reinvent the model. So there is challenge in the sector. The growth rates are 3-4%, and they will remain so for next few quarters on a year-over-year basis. And at the same time, the multiples are not at all low. So we are not very excited about the sector. I think there are still challenges in the sector which are there.
That exactly is a big concern. Why are the fund managers, the market experts, the market participants not excited about the IT sector? I mean, information technology, digital advancement. We have seen how the picture completely changed from the COVID times, and we have seen the advancement of digitalization for that matter. But yes, coming more to the IT sector, has revenue growth bottomed out for Indian IT company, or is there more pain ahead? And also, while we see what's driving the slowdown in discretionary spending across clients.
So there are multiple things which have come. First of all, post-COVID period should not be compared because before that 1 year there was no growth, 1 or 2 years. So there was a bundling up of spend post-COVID which helped. Now after that, what has happened? We have seen multiple issues because US economy has been under fear of recession, which could be hard landing, soft landing. No one knows. Then there were tariff issues. There is lack of clarity. Still, the clients don't know what will happen. How will the supply chains get impacted? So they are not willing to commit big money. That impacts the discretionary part. Second, on the top of that, this whole impact of the new technology, the AI revolution which has come, it is cutting down efforts very, very substantially. And when efforts go down so much, then there is only so much you can increase on the realization, if at all you can. And which means that your growth rate will low remain. So the question which you asked, that whether we have hit the bottom, I would say that we have hit the bottom of the range, but this will continue for a few more quarters. So it will not be that from 3% growth you will see 10% or 8% growth quickly. This will remain between 0 to 3-4% for several quarters to come, in my view, on a year-over-year basis. And that is what every market participant is worried. And that is the reason you will not see much reaction on the stocks.
Okay, Sandeep, one more thing, harsh but the truth for IT sector, attrition, hiring and firing game. Now, this is nothing new, particularly for IT sector, a sector which requires so much technological hands and healthy minds to actually work on. Is cost control alone be enough to protect the margins or the picture of the IT sector at present? Is this the only solution, and will this sustain going ahead also?
No, so people are doing what they can do quickly. So the easiest way to improve margins or maintain margin is to contain the cost, and that is what is happening. Secondly, fortunately, unfortunately, if you see the offer letters which are there in IT sector since last 30 years, they simply the bonuses and the pays, everything are correlated. Increments, everything is correlated to the company's performance and the individual's performance. So company's performance is not there. So you can. Basically, that is the argument which has been given for not giving hikes and not giving bonuses, and I think that will remain same for till the time growth comes in. I believe that till growth comes back, the scenario will not improve for anyone, and margins will also at some point of time succumb to this pressure. You can manage margin for some quarters by not giving the wage hike and the bonuses, but beyond the point, you will not be able to defend them. Finally, volume is required, operating leverage is required.
Yes, difficult decisions have to be taken when it's the need of the hour. But Sandeep, one more thing for the young minds who are listening and watching us at present, with hiring on pause, what does that indicate about the medium-term demand outlook for the IT companies and IT sector all in all?
So I honestly think that less than 3 years, there will be good demand for people. More than 3 years, right now there is no much hiring happening, but in few months you will see less than 3 years, again demand will come. So I'm not worried about the young minds which are coming out of the college. I am more worried of the people who are there for long time in the system and they have not upskilled them because their costs are high and they are not contributing substantially to the revenue, particularly in the new technology. So I think that is the place where there is massive mismatch, and I think that is the space where there will be very high risk of involuntary attrition triggering in at some point of time. So I'm not worried about the new people at all.
Okay, so Yes, the time will come, and the young minds also will get a chance to again re-enter. And for the right candidate, there's always a place, as they say. But what happened with the IT sector, if we talk about the overall picture, along with the earnings, not just the larger IT players, but the mid-cap IT game as well, the environment still remains dynamic and uncertain. While slowdown in manufacturing with cutbacks in discretionary spending is another thing which one needs to consider. Lower utilization, no major headcount addition, financial segment is performing better than manufacturing segment, and at the same time, continued weakness in manufacturing and client-specific issues in high-tech segment is another concern which one needs to consider while talking about the IT plays. Sandeep, is FY26 a make or break year for large-cap ITs?
I think it will be tough to make in this year. This is a tough year. And the probability of any good, because see, we are a first half driven industry for India, because so in the third quarter, which is December quarter, you have less number of working days. So there is a high furlough, so you can't anyway build much. And again, then in the fourth quarter, there is less number of days in month of February. So you are again challenged. So I think, it will be tough.
One needs to keep the sector in itself in watch list for that matter. At present, not performing. But again, the next question, Sandeep, is for the investors and market participants who are eyeing big on the IT sector, and the conviction is less at present, even for the market participants looking at the numbers and the last returns for the IT companies altogether, the larger as well as mid-cap IT plays. But what should investors watch out for in the second quarter to assess the potential demand revival?
So the only thing to assess is there will be two things which will give you a sign of revival. One, if the attrition shoots up by 3-4% in one quarter, it will be a sign that there is some voluntary attrition, not involuntary. So if voluntary attrition moves up by
Okay, so there is a technical glitch, but Sandeep has given us a quite detailed view on the IT sector. All in all, at present, the condition seems to be a little bit of a concern, a little bit more of a concern, because of the larger IT plays coming up with numbers which were not really a strong show. But at the same time, we need to be hopeful for the sector. We'll see some good uptick moving ahead. Abhishek, thank you so much for joining with us and helping us with the research on the IT. With that, it's a wrap on ET Now Inside for now. But there's a lot on the other side. Stay tuned with ET Now.